Assalamualaikum warahmatullahi wabarakatuh. Hi everyone, we are from Group 3. We will present about how securities are traded. Member of the Group 3 consists of Dinny Firvidiani and me, Rofifah Rizda. Enjoy to see our video. For the first, I gonna tell about brokerage transactions. And in this objective, we will know about the role brokerage firms and brokerage accounts. 1. Brokerage firms. Brokerage firms are financial institutions that help us to buy and sell securities and act as the middleman between the buyer and the seller. Brokerage firms can be classified. First, full-service brokers. Brokerage firms offering order executions, information on markets and firms, and investment advice. And the second, discount brokers. In these brokers, offering order executions service for buying and selling securities. And these brokers really cheaper than full-service brokers. Some may offer research and recommendations. And then, brokers might also sell mutual funds, facilitate IPO, and underwrite new issues. And the 2, brokerage account. In this brokerage is an arrangement where an investor deposit money with a licensed brokerage firm who places notes on behalf of the customer. The type of brokerage account. First, cash account. The most common type of brokerage account in which the customer pays the brokerage account, in which the customer pays the brokerage house the full price of any securities purchase. And the second, cash management account. In this cash management account is a brokerage account that allows the customers to borrow from the brokerage firms to purchase securities. And the last one, wrap account. Wrap account is a new type of brokerage account where all costs are wrapped in one fee. And then, dividend reinvestment plans. In this brokerage offered by companies, an investor can buy stock through brokers or sometimes directly from the company. And then, brokers-less account. This is brokers' direct stock purchase program or DSPs, and then Treasury Direct Program. And the next slide about order executions. Order executions have the type about trading on today's exchange. Trading on today's exchange use both physical auctions and automatic trading system. An auction for those seeking the best price, automated system for those seeking quick executions. And then order in the Nasdaq stock market. This is about electronic but also use market makers. And the third, market makers stand ready to buy or sell certain securities, thereby matching supply with demand. And the fourth, algorithmic trading. Algorithmic trading, computer algorithm determine order details and then used by large institutional investors to break orders into smaller pieces. And the last one, high frequency traders. This is have a little effects on individual buy and hold investors. Type of orders have a 3 types. First, market orders. Market orders is authorized immediate transactions at the best available price. And 2. Limit orders. This specifies a particular market price before a transaction is authorized. And the last one, stop orders. The stop orders specifies a particular market price at which a market order is authorized. And the next slide about settlement. Settlement is most settlement dates are 3 business days after the trade date. And settlement, legal ownership, transfer, and financial arrangement settle with brokerage firms. And most customers have brokers each hold share on their behalf. And for the next slide, we will present by my friends Dinny Firvidiani.
Hi, my name is Dinny Firvidiani, so I will continue the presentations. So investors should be concerned that security market are properly regulated for their protections. Our financial system is really depends on that. And investor protections can be divided into government regulation, primarily federal and self-regulations by the industry. First, we're talking about government regulations. Much of the legislations governing the securities market and industry was enacted during the Great Depressions. Many fraudulent that happened. So, the market as a whole were shattered in the crash of 1929, and Congress subsequently sought to improve the stability and viability of the securities market, enacting the basis of all securities regulation in the 1930s. Next, we're talking about Securities and Exchange Commission. In 1934, Congress SEC as an independent quasi-judicial agency of the U.S. government. Its mission is to administer laws in the securities field and to protect investors in the public in securities transactions. Requires issuer registration for public offers, investigates indications of violations such as insider trading, and Securities Investor Protections Act of 1970 ensures account. Now, self-regulations. Stock exchanges are also itself regulated. It means it wants self-interest to regulate and monitor member behavior. And the NYCE circuit breakers attempt to reduce volatility. Next, Financial Industry Regulatory Authority or FINRA. It is the largest regulator of U.S. securities firm, and its objective to protect investor and ensure market integrity. And the last one is other investor protections. We have two. First, the Security Investor Protections Corporation or SIPC, that non-profit and membership corporation overseen by the SIC. It ensures each customer accounts of its member brokers against brokerage firm failure. And we have mediations and arbitrations. So that is the process through which investor may resolve dispute with brokers, and mediation decisions are non-binding but arbitration decisions are binding. We're talking about a margin. So margin is the investor equities. It is the percent of total value that is not borrowed from the broker. To open margin account, exchange set minimum require deposit of cash or securities, and investor then pays part of investment cost, borrows remainder from broker. And how margin accounts can be used? First, purchase additional securities by leveraging the value of the eligible shares to buy more. Then, borrow money from a brokerage account for personal purpose. And the last one, we provide overdraft protections in amounts up to the loan value of the marginable securities for checks rate return. So, Federal Reserve sets the minimum initial margin on securities and as that is unchanged since 1974 at 50%, and the amount investor provide divided by value of transactions. And actual margin anytime cannot go below the maintenance margin level. So investor equity changes with securities price and margin call when equity below maintenance level. Now we're talking about short sales. Investor that buy a stock is long, expect price of stock he doesn't own to decline, can borrow stock then sell it short. Borrowed securities sold in open market to be repurchased later at an expected price lower than sale price. Short interest ratio indicates how bearish investors are about a stock. So, short sell is the sell of a stock not owned in order to take advantage of an expected decline in the price of the stock. So, here are the process of short selling. First, you think a particular stock's price will decline. Then you instruct your brokers to establish a short positions in this stock, and then the brokers borrow the shares, sells them, and credit your account. And then the price declines, so you buy the stock back and replace the borrowed share. And the last one, you closes out your short position on which you made a profit. And the last one is selling short as an investor. Short sellers argue that short sales help the overall market, and short interest ratio is the ratio of total share sold short to average daily trading volume. The higher the ratio, the more bearish they are. Okay, that's all our presentations about how securities are traded. Last word, I want to invite all of you guys to start investing because it truly helps our economy during the COVID-19 pandemic like today, and it also be useful for our financial futures. So what are you waiting for? Yuk nabung saham.